Right, so we will start to be able to keep our timing this morning. So welcome again to everyone for the launch event of this brand new study with regards to ESG trends applying to real estate assets. I'm delighted to be with you today, and I'll be your host. This morning we'll be together for 2 hours from 10 till 12 a.m. Central European time. My name is Etienne Denoy. I'm the CEO of Green Soluce. And we are carrying out this study in partnership with IEIF, and I'd like to warmly welcome Christian de Kerangal, CEO of IEIF, as well as all of our partners, because this is a collaborative endeavor, Eiendom Denmark, EPRA, INREV, IPF, IVBN, Norsk Eiendom, Rackley, Women in Real Estate, Spain, and I don't think that I've forgotten anyone. We've been working on this study for over a year now, and it's the first of its kind, so pretty much unique in the sustainable finance space. For those who don't know Green Soluce and IEIF, just a very quick word about us. Green Soluce, we're a new kind of advisory firm. We combine the best of sustainability consulting as well as digital solutions to help public and private players across Europe, especially to embrace the sustainability transition. And we focus, we have a big focus on real assets, real estate, infrastructure, as well as private equity for sustainable finance players. And IEIF is a pioneering research center dedicated to real estate, both in France and Europe. With regards to our agenda today, as mentioned, we'll be together for 2 hours with first start of welcome remarks by Lonneke Løvik, CEO of INREV, and Dominic Meurenhout, CEO of EPRA. Then we'll be diving into the presentation of the results of the study. There'll be a short time for questions at the end of the presentation, and you may use the Q&A section of Zoom. We won't be able to pass on the mic to everyone, but we'll definitely make sure that we can take your questions into account. And then we're very lucky to have a panel discussion today with an amazing bunch of panelists: Abigail Dean from Nouvean Real Estate, Nicolas Jandot from Justina, Stéphane Vimin from Ivanhoe Cambridge, and Christopher Wright from Norges Bank Investment Management. And we'll finish off our session with a Q&A and wrap up. So quite a big agenda this morning. I will be sure to keep it. So I'd like to pass on the virtual mic to Lonneke Løvik. Please, Lonneke, welcome and thank you for being with us.
Thank you, Ella, and good morning all. As Ella said, my name is Lonneke Løvik. I'm the CEO of INREV, which is the Association for Institutional Investors in European non-listed real estate. What we've seen over the last decade, that our industry has acknowledged the importance of integrated ESG aspects into investment decisions. And most of our investor members have a long investment horizons, and it's essential to have a fully integrated ESG strategy, as most ESG issues are likely to be material when assessed over longer periods. And action should be taken now to avoid obsolescence of assets going forward. What we saw is that initially the industry was focused on energy saving and greenhouse gas emissions, but in the past few years, with climate change emergency, many investors and investor manager members of us have also started to assess the impact of climate risk on their portfolios. By doing so, one can identify potential ESG-related risks before they become material. And there is a growing awareness to manage and mitigate physical risk of climate change and the risk associated with the transitions to a low-carbon economy. And investors and managers are moving their building towards net zero. As INREV, we support initiatives that identify climate risk, promote sustainable investments, and the transition towards net zero at regional level, such as the CRAM project for Europe. In the past year, with the COVID crisis, we saw that COVID-19 impacted how investors and managers approach ESG, and noticed a significant increased interest to achieve social as well as government aspects beyond environmental. Another major change that we're seeing today is that ESG performance and reporting have gained importance. It used to rely on voluntary reporting standards such as the INREF Sustainability Reporting Guidelines. However, regulators are becoming more proactive, especially in Europe, if you think about the EU SFDRs and the EU taxonomy. And these are very important developments to achieve harmonization and standardization of ESG reporting, which is absolutely essential for transparency in ESG performance. ESG risk exposure and opportunities still vary from country to country, region to region, because of the local differences between governance standards, strength of ESG regulations, and other factors such as community engagement. And cross-border studies, like the one we will hear the results of today and will be discussing, are important studies to help real estate players who have cross-border activities and who need to take ESG issues into account with regulatory differences. As such, I'm very much looking forward to hear the results of the study today. And thank you very much for conducting this study and for everyone who has taken part in responding to the survey. Thank you very much. Dominic, up to you.
Yeah, okay, thank you, Lonneke. And of course, I can only endorse what you just said. So first of all, a very good morning, everyone. I think it's great to see so many people joining the webinar today. So as Lonneke also said, it's very clear that ESG principles have become strategic to every business and every industry stakeholder, as we see, and we have seen over the last years, a huge uptake of interest among investors. For more than a decade now, since the introduction of the EPRA Sustainability Best Practice Recommendation, which is the sole industry standard for ESG reporting among the listed European companies. Our ambition at EPRA is definitely to enhance ESG performance of the sector by providing both transparent and comparable information for investors. And this is also one of the key reasons why we were very pleased to be invited by Green Soluce and IEIF on this initiative, because in our eyes, it really offers a unique glimpse into sustainability investment practices and policies from a pan-European perspective. So first of all, of course, a big thank you to Green Soluce and IEF for taking this initiative. From the study, which will be, of course, presented at large a bit later by Christian and Ella. So there are just 2 points from that study, which I would like to briefly highlight here as an introduction. Is first of all, is the availability and quality of data. And the other one, which Lonneke also referred to, is a regulation. So the lack of structure, consistency, and quality in the data reported has always drawn criticism, and that's true in any type of real estate investment. So that's why EPRA, we took a first step in addressing this gap 2 years ago by launching a database which covers all publicly available ESG data from European listed real estate companies. The database enables today investors to analyze, but also to compare key ESG metrics to understand any company's exposure to climate-related or reputational risks and opportunities, but also to some extent its potential financial implications. So today's study really demonstrates that this is not only an issue for the listed sector, and that there is still more to do to enable comparability across the industry. On the regulatory front, Lonneke mentioned it also, so the EU taxonomy is mentioned very high on everyone's agenda today, with a common understanding that it will move the real estate sector forward and accelerate the transition by providing what we call a single market standard. While we agree with this assessment, we also share the concerns of the respondents about the legislation as it exists today, not addressing the key challenges of incentivizing the renovation of our existing buildings in the EU. New buildings will undoubtedly serve an important part in upgrading our infrastructure in Europe, but we must not lose sight of the fact that the most effective thing we can do to address the climate crisis is to increase the efficiency of our existing stock. With over 35% of the buildings in the EU being over 50 years old and an annual renovation rate of around 1.5%, the taxonomy should give a clear signal to the sector that sustainable built environment assets must aim for carbon reduction and mitigation across the whole life cycle. So this is the message EPRA will continue to push forward in the coming months and years, and this is even today further backed up by the study you will discover in detail in a few minutes. So thank you very much for your attention today. I think it's going to be a great webinar with great panelists. I think you will be very pleased to hear, first of all, the results of the study, but also more importantly, how real estate practitioners embrace the whole ESG framework today. So Christian, thanks for inviting us again, and I leave you the floor now. Thank you. You have to unmute yourself.
Sorry. Thank you very much, Lonneke. Thank you, Dominique, and good morning to everybody from north to south of Europe. I will. The main objective of our study was to conduct a broad evaluation of real estate investment practices, to draw inspiration for better practices, and to have a global understanding of the prospective view of the sector on ESG. So perhaps we can go to next slide. And again, so I will, the first thing I will focus on the scope of the study. Then Ella will come back on an overview of sustainable investment best practices and sustainability policies. I will come back to tell you some key points on challenges and drivers. And then Ella will draw prospective ESG trends for real estate investment. So some on the scope of the study. First of all, I want to thank again the 10 real estate association, both European and national association throughout Western Europe, which partners with us on this study. So this study is based on a quantitative survey that gathered 93 answers from European institutional investors, listed property companies, and European fund managers, with a total asset under management a little bit less than 800 billion euros of real estate, so which is huge. We hope that we will increase again the size of this sample in the next editions of our study. We also conducted 25 interviews of leading real estate players during 4 months between December 2020 and March 2021. Next slide, please. So, as I told you, we had a questionnaire which covered 15 European countries, and when we split the answers by a type of respondent, if you look by numbers, you've got roughly a third of fund managers, a third of institutional investors, and a third of property companies. But when we look by asset under management, it's a little bit less than 60% of fund managers, 28% of property companies, and the rest of institutional investors. Looking the breakdown by geography, we've got, and looking by asset under management, you've got France first, then Germany, then UK, and then Benelux, Spain, Nordics, and other.
Thank you, Christian, for talking about the scope of the study. So I'm going to dive in with you with regards to an overview of sustainable investment best practices and sustainability policies. We'll move on to the next slide. So what do we see? What do we see in the figures today with regards to sustainable investment best practices and sustainability policies? So first of all, if you look at Figure 6, we see that the percentage of real estate assets under management portfolio in Europe that are covered by an ESG policy is high, over 75% for fund managers, property companies, and institutional investors reach 95%. So we've got a very good coverage among financial players with regards to ESG policies. If you look at the policy coverage target in the next 5 years for the share of real estate that is not currently covered by type of respondent, that figure reaches 75%. That's the part of the graph that is in dark blue. And then it's also interesting when you're looking at sustainability best practices and policies to look at whether property companies, fund managers, institutional investors have a dedicated ESG person, and whether that person is on the executive board. And I'd like to highlight two figures here. First of all, the figure of 64%, which is the case for property companies. 64%, that's a dedicated ESG person in property companies that sits on the executive board. For institutional investors, that figure is 30%, probably linked based on the interviews that we've had with the players that we surveyed, linked to the fact that institutional investors rely on their fund managers and their councils with regards to ESG expertise. We'll move on to the next slide, please. Right. In terms of the issues that we can highlight here with regards to best practices and sustainability policies, there is a clear standout with regards to energy and carbon. Energy and carbon are the issues that are most closely monitored by a majority of real estate market players. And what we see is that 87% of respondents take into account environmental issues at large, and that 60% of the real estate market closely monitors energy and carbon issues. What do you see on the graph? We show you how the different topics are considered, how the different ESG issues are considered, whether there are target figures, and whether these issues are closely monitored. Energy and carbon clearly stand out from being considered, having targets, and being monitored. When we look at water, resilience to climate change, which is climate change adaptation, circular economy, and biodiversity, those are the topics that are today the least considered by the different players. Coming to, after having looked at the E of ESG, that stands for environmental, I'd like to dive into the S, which means social, and also from a societal perspective, because that's also important. 85% of respondents to our survey take into account social issues. And it's also interesting to note that 64% of those respondents consider that social criteria will increase in the next year. In the sustainable finance ecosystem applied to real assets, and especially real estate, we hear a lot about environmental issues, but social topics are also gaining increasingly traction. Maybe in terms of the key figures of the graph, if you take a look, we've got a community engagement and inclusion and diversity, respectively at 21%, that are being the least considered today. And we'll see in the panel that affordability, accessibility are key issues with regards to the social aspect of ESG. We'll pass on to the next slide, please. With regards to governance, that's the G of ESG. 93% of respondents say they take into account governance issue. 59% of those respondents indicate that the G governance will increase in the next year. So we see a real trend of taking of respondents wanting to take into account the full scope of ESG, and the topic with regards to governance that stands out here is anti-bribery and anti-corruption with regards to real estate, that are the most monitored, as you can see, at a 21% level. It's also interesting when you look at sustainability best practices and policies to look at the frameworks. And there are a number of frameworks available on the market today, and we wanted to give you a clear overview of how those frameworks are being used today. Definitely what stands out from the figures and from the market is that GRESB and the the Principles for Responsible Investment by the United Nations are the most chosen frameworks by all the entities. But when you break these frameworks down by reporting entities, there is a trend here that is slightly different from one type of respondent to the next. GRESB has definitely become the reference tool that is used by real estate investment professionals. UNPRI is a framework that is mostly used by institutional investors and fund managers, and TCFD and GRI are used respectively by 28% and 30% of respondents with regards to reporting standards, and they seem to serve the reporting needs of all types of players, of financial players. Christian, back to you for the challenges and drivers.
Yes. Thank you very much. Going to the next slide, please. So what appears to out of the quantitative survey and also all the interviews are there are let's say four main barriers or challenges has to be addressed in order to increase ESG integration into real estate strategies. The first barrier is the complexity of processes, especially when we look at reporting requirements and resources involvement. The second thing is the lack of normative framework in general, but more specifically when we talk about biodiversity, circular economy, and data management, which was highly mentioned by Dominique. The third barrier or challenge to address is the cost of integrating ESG into real estate strategies. And the third one, which is at the same level, is the impact it will have on the return on assets. And we can also mention that fund managers are the most concerned by the multiplicity of certification, and this may be related to the fact that they manage different asset classes in different countries, which means they are confronted with a large number of certifications. And last challenge, but which is also very important, is the lack of consistency between national and EU regulation, the lack of consistency, around definition, which is the first challenge to address. Next slide, please. If we look to the different countries, we found the same challenges, but we can just highlight some other challenges which has been highlighted in France. Training, the need for training and awareness raising of stakeholders, and in Germany, the lack of consistency between national and EU regulation. So there are some challenges, but there are also some drivers. And let's come now to the drivers. What are the main drivers which will lead to ESG integration? The first of all the drivers is investors' demand, which is the more important and which is increasing year after year. The second thing is the fact that it will integrate ESG into real estate strategy, will lead to lower the risk and to clearly enhancing and protecting value of the assets. And the third driver is the need, of course, to be compliant with local government policies. If we come to the, of course, we find all these points if we regard the first three drivers country by country. In Spain, the players highlighted tenant attraction also, and in Germany again the need of compliance with existing or anticipated European government policies. So Ella, to Prospective ESG Trends.
Yes, thank you, Christian. So I'd like to take all our audience into the future and look at prospective ESG trends for real estate investment. So first of all, a graph that summarizes these prospective trends. It's one of my favorite graphs in the study. It gives a nice overview of the 8 key ESG issues that we identified through the various interviews, and they're presented in the priority issues grid below, according to the interviewee's perception. So the level of priority of each issue you can see on the y-axis, and the complexity of implementation of each issue on the x-axis. I'd like to focus on 3 main issues that have been addressed: carbon, data, and regulations. Maybe a quick word with regards to carbon. While buildings account for around 30% of global greenhouse gas emissions in Europe, asset managers are defining roadmaps for carbon reduction, which is seen as the main lever to limit climate change. With regards to data, as Dominic Murenhout of EPRA mentioned, defining harmonized market practices and a single tool to centralize data will be key. With regards to regulations, regulations create a sense of urgency and definitely drive ESG best practices approaches among market players, but they still require harmonization and convergence between local and European regulation frameworks. We can pass on to the next slide, please. Okay, in terms of challenges and initiatives with regards to prospective ESG trends, the ability to upgrade the existing stock is identified as the most valuable initiative to address the carbon issue. If there was one message to get out from this slide, this would be it. With regards to the key challenges that we see, reducing embedded carbon, so all the carbon emissions along the life cycle of a building from its construction, which accounts for 60% of the carbon footprint, along with operations till the end of the life cycle. That's embedded carbon, and that's a key issue. Achieving carbon sobriety by 2050. We have carbon neutrality target in Europe by 2050, also known as the net zero carbon objective, which real estate players are embracing increasingly. Renovation of the existing real estate stock is one of the key trends, and stringent regulation and harmonization at European level is definitely also one key challenge, as regulations differ from one country to the next, even if there's a push at a European level. If we look at the initiatives here, there are decarbonisation solutions for the real estate sector that are increasingly multiplying, renovation of existing buildings and restoring assets with a strong low carbon approach, use of renewable energies, energy efficiency solutions, insulation, technical equipment, joinery, metering, and the whole trend with regards to smart building can be here mentioned today. Passive solutions also help address these key challenges, as they are linked to adaptation. An efficient carbon tax was mentioned by our participants in the study, based on a polluter pays principle, and the European carbon tax currently is perceived as ineffective because it does not provide enough incentives. I'd also like to mention the EU-funded research project CREM, which means Carbon Risk Real Estate Monitor, which provides a view by asset and by portfolio of the level of alignment with a 2-degree or 1.5-degree trajectory, and defines the tipping points towards environmental obsolescence and allows a risk-based approach. Finally, the net zero carbon building framework of the World Green Building Council, WGBC, is worth mentioning. The goal of this framework is to set in place a path to achieve net zero carbon buildings in both construction and operations. Move on to the next slide. With regards to challenges and initiatives, we can go further with regards to what real estate stakeholders are taking into account. And data management is a strategic priority. Data is one of the key topics to be able to move and drive ESG further and forward. First of all, in terms of the challenges with regards to data management, the frameworks with different expectations, the question of quality, reliability, completeness, consistency, and comparability of the data are key priorities in the months and years to come. And the need for clear guidelines from the regulator is also a point that needs to be that's worth stressing here. Initiatives, environmental data collection policy is on the rise and increasingly used by real estate professionals. Working with counterparties to ensure reliability of data is also increasing. Real-time data systems and big data technologies are definitely also on respondents' radar. And finally, the whole movement with regards to the digital twin of the building, the BIM dynamic in terms of structuring data is also key with regards to what stakeholders have mentioned. I'd like also to look at specifically regulations after having looked at data, because regulations drive sustainable best practices within the real estate sector. The challenges are we need more harmonization, convergence between local and European regulation frameworks, as already mentioned. Regulations mean organizing, responding to these regulations, and that's more time and human resources to meet the increasing reporting requirements. Educational work as well with legislators, that's a key point to be able to explain the specificity of real estate compared to other asset classes. And regulators have listed securities in mind, but do they really have a deep understanding of what it means to tackle real assets? And that's a key point here to bear in mind. I'd also like to stress this key idea of promoting a positive vision of regulation. When we think of regulations in the real estate sector, we think of constraints. We need regulators at national and European level to embrace the sector positively and to help market players reward ESG best practices and help give the frameworks that are needed, not in a punishment-based approach, but really in a constructive approach where the regulator is the partner of market players. And then, of course, a key challenge with regards to regulations is a focus on regulating the existing stock. I'd just like to mention one key percentage here. New construction is only 1% of the market, 1%. The key part of the market is the existing building stock. I'd like to finish with one key slide. As mentioned in the introduction by Lonneke and Dominique from INREV and EPRA, the European taxonomy is a key focus of real estate respondents, and we've all got the European taxonomy on our radar. And there are different levels of understanding and expectations towards this taxonomy. 58% of the respondents have started preparing for the European taxonomy, and that trend is accelerating. And there is a consensus among market players that the European taxonomy will move the real estate sector forward by defining a single market standard and a unified approach, which we need in Europe to be able to have a clear level in terms of playing field. With regards to the overall level of understanding of the implications for real estate investment and the European taxonomy project, most respondents would be situated between adequate and good. A very good level of understanding is yet to come. And that's what we need to work on with all real estate players. Just a very quick word on the limitations of the European taxonomy according to the real estate market players, and that's as of February 2021. There's a strong focus on energy at the moment and less on carbon with regards to taxonomy, and we're not taking into account at the moment the entire life cycle of the building, what I was mentioning with regards to embedded carbon. There's a focus on financing new buildings and not on existing buildings, which is a point that will need to be addressed. And there is a strong trend in the European taxonomy to impose very high requirements and maybe less on the incentive side. And the application of the taxonomy will vary according to local legislation. So there's always this notion between local, national, and European level. Thank you very much.
Thank you, Ella. There's a lot of interest amongst the participants, and there are quite a lot of questions. What I suggest is that I will only mention the question, and then we will address it through the panel discussion. Just some question was, could you comment on how to address the valuation premium for green buildings and the ROE on green capex, which effectively is our key elements, and we will come on during the roundtable. One person said carbon sobriety, how could we define it? Could we comment on the potential availability of a European ESG label in the future? So this is also a key element. Another person comment on the ESG pillars and the criteria used here, which seems to be taken more from usual financial asset management approach and therefore not directly adapted to real estate management. Another question was, what is the view on RICs, and carbon offset, and what can be expected in terms of price volatility of these credits and offsets? So these are some questions. I just want to mention, because there are also a lot of questions on will the study will be available or not. Of course, the study will be available on both Green Soluce and IEIF website, as well as the presentation, as some people asked for. So Ella, the floor is yours for the roundtable.
Perfect. Thanks, Christian. And with regards to the availability of the study, please feel free to download the study after the webinar. It will be available, as Christian mentioned, from 12 o'clock onwards with no problem on both of our websites. So we're going to now take you into our panel discussion. And I thank you for your attention up until now, and I hope you can stay with us for this exciting talk. I'd like to welcome our panelists that I will introduce briefly. Abigail Dean, sorry. Thanks for being with us. You are the Global Head of Strategic Insights at Nouvean Real Estate. Thank you for accepting our invitation. We're delighted to have you with us today. Nicolas Jandot, who should be with us as well. I can't see Nicholas yet. Right, now I see you. You are the CSR Director at Gecina. Stéphane Vimin, welcome. You are Vice President Corporate Social Responsibility at Ivanhoe Cambridge. Lovely to have you with us today. And Christopher Wright, you are Head of ESG Risk Monitoring at Norges Bank Investment Management. Thanks for being with us. Can everyone hear me? Are we right in terms of connection? Perfect. So the idea with our panelists today is to be able to share your exclusive insights on ESG trends, the challenges that faces the industry at European level. Also, for some of you with a global perspective, Ivanhoe Cambridge and Norges Investment Bank, you have a global view also on ESG, as well as Nouvean, and to give our audience an idea of those trends, challenges that practitioners face. Before we dive into the questions, just to give our audience an idea of the topics that we'll be mentioning today, there are 5 topics that we'll be looking at. First of all, we'll be digging into carbon and energy transition. As we saw in the presentation of the study's results, those are 2 key topics for the real estate market today. We'll also be looking at the lack of shared frameworks and definitions, addressing also social issues that are on the rise and how practitioners are taking into account the S of ESG. We'd also like to have your perspective on the relation between financial performance and extra financial performance, which is a key topic, and we'll end with your view on prospective trends. So with regards to carbon and energy, let's look at this hot European topic at the moment. Christopher Wright, can you give us your view with regards to energy and carbon, and maybe look at the question of whether the regulatory risk is more tightly linked with carbon emissions associated with a building, or whether it is linked to the energy use of a building. I mean, it's a very specific topic, but that comes up pretty much. If you can tell us a little bit about that.
Sure, Ella, and I just want to start by thanking for the invitation to join the panel. It's very, very interesting and obviously topical themes you're discussing today. So on regulatory trends, you already mentioned, Ella, in your introduction why this is relevant to real estate, and that's of course that the real estate sector accounts for a large share of emissions. So any government that has ambitions, for example, to achieve net zero by a certain year, 2050 or 2040 or 2060, in the case of China, will have to address real estate. So that's the basic math suggests that there will be regulatory efforts, and those will be increasingly stringent and affect the market much more than it has in the past. So what we are seeing, so as at Norges Bank, we have an unlisted portfolio of about 275 billion kroner, and 75% of that is spread across major global gateway cities. And those cities are really driving this trend. They are setting the most ambitious targets. Some of them are setting targets beyond what their national governments are requiring or setting. And they have populations that are really interested in green spaces, sustainable development in urban centers, and this is reflected in what tenants want in those cities. And so we see that in our asset management, that this is becoming increasingly important. So what does it mean for, or how does it actually make itself relevant? Well, the example in the recent example in France is perhaps indicative of what we think is a broader trend, which is that governments will set targets for building owners that they have to meet, and if they don't meet those targets, they might be fined, or even perhaps even more consequentially, they might be so-called named and shamed. They might actually be disclosed, and so any tenant or occupier could then, using public information, identify whether buildings are managed in accordance with a net zero target or not. And these kinds of regulations will change how building owners have to think about energy and carbon. And I can talk very briefly about what has to be done or what is being done. One is that within fund managers, and I would also say institutional investors, this topic is becoming much more part of the core function of investment. It is no longer a peripheral activity that can be kind of managed by a separate team. It has to be integrated into asset planning, for example, and long-term strategy. So that's one. The other is, of course, that everyone is now concerned about how their buildings are performing today relative to the target they have to achieve in the future. So you see a lot of energy auditing activity to understand the baseline. And of course, those building owners and asset managers that have done this in the past that have systems for measuring and monitoring are a step ahead and have clear advantages relative to managing the compliance risk that comes with the regulation. And then I would say, as just to finalize on that point, is that it also will impact the relationships between landlords and tenants, because tenants, of course, impact, well, in two ways. One is that they impact the energy use of a building, and the landlords might be responsible for that energy use in the future, and therefore have an incentive to encourage tenants to conserve their own energy. And number two is, of course, tenants might want to occupy buildings that have low carbon emissions as a means to achieve their own corporate targets. Not only real estate companies are setting net zero targets for themselves, but also the occupiers of buildings. And so this creates a kind of a push and pull in both directions that will mean that relationship becomes much more important. So that's what Lonika said in her remarks as a conclusion, is that we need to increasingly assess these risks before they materialize, to prepare for a future where the carbon emissions from building is increasingly constrained, it's increasingly disclosed and shared, and hopefully also comparable across buildings and across portfolios.
Thanks, Christopher, for those insights. And I'd like to talk a little bit more about the net zero carbon pathway that you mentioned. Abigail, at Nouvean Real Estate, to respond to the carbon challenge that faces the industry, you have implemented a net zero carbon pathway. Can you tell us a bit more about what that target means for a fund manager and how you proceeded?
Yeah, sure. Thanks, Ella. So we've set a target for Nouvean Real Estate to achieve net zero carbon by 2040, and that applies across our whole real estate investment portfolio, which is a global portfolio totaling just over $130 billion of assets under management. And the reason that we've set that goal picks up on a lot of the themes that you just had discussed by Christopher and that were picked up in the earlier presentation, which is that we see this move from regulation to push buildings to become net zero carbon. As Christopher sort of mentioned, the fact that real estate accounts for a significant proportion of the carbon emissions of any country, and therefore there is this inevitable policy response that we see coming that will fall onto real estate, which means that all existing buildings are going to have to get to net zero carbon. The World Green Building Council has said that needs to happen by 2050. I think that the real estate industry is coalescing around that being a realistic, ambitious goal. And what that means is that as we get closer to that date, real estate that is not net zero carbon is going to fall foul of fines, is going to have restrictions put on it to be leased, and is going to start losing value. Tenants increasingly are going to want to be in low carbon buildings, as we've also had mentioned, and to meet their own science-based target goals to achieve net zero carbon. And the investor community is really mobilizing around this issue as well. A lot of the institutional investors that we work with have set net zero carbon goals for their entire investment portfolios, and real estate has to play a key part of that. So for us, we really needed to have a pathway to achieve net zero carbon in order to be good stewards of the capital that we manage, to ensure that we're not investing in real estate that's going to be losing value, and to ensure that we are investing in and protecting the value of the real estate within our portfolio, and to ensure that we are meeting the needs of our clients as well. What that pathway looks like is we've set a number of milestones to focus on improving the energy efficiency of existing real estate, to reduce the embodied carbon in any development work that we do, to get a much more comprehensive picture of the tenant energy consumption in our buildings and the carbon emissions associated with that, because that's also included in our goal. And to sort of really improve that data gathering, and then to roll out renewable energy across our portfolio as well, so that we can significantly improve the energy efficiency of our assets first in the first 5 years, and then start to decarbonize heat across our buildings, rollout of renewables, changing all contracts to renewable energy, and significantly reducing embodied carbon as well. So a number of key milestones for us there, and we really do think that what this will mean is that our portfolios will be protecting their value better as we move towards that end goal.
Are there any specific challenges that you'd like to stress with regards to this ambitious pathway and share with our audience? Because that's also, of course, interesting to hear your thoughts on that. And Christopher, if there are any other points that you'd like to stress, please do so.
I think for me there are a lot of challenges, but there are three that really stand out. So the first is a lack of a clear certification which identifies a net zero carbon building. So there are a lot of really helpful frameworks out there and research that's been done on looking at what the decarbonisation of real estate needs to look like, but applying that to an individual building and being able to state clearly this building has reached that standard or hasn't, that there is no independent third-party body that will do that yet. So I think that's coming, but that would give a lot of clarity to the industry and would remove a lot of the uncertainty and noise around this issue. So if we were able to clearly state, we want our building to achieve this certification in net zero carbon, this is a realistic timetable to get there. All of the partners that we work with in terms of managing that building, doing upgrade work to that building, helping to design that building, would understand what that means, and we could all work there together. So a clear certification of buildings and the lack thereof is one of the key challenges. The other is around that, the working with tenants. So I mentioned that we are focusing on getting better data from our tenants. They have no legal obligation in most instances to share that information with us, but the energy consumption of tenants in the building is, in many instances, the majority of the carbon emissions associated with that. And we need to be able to accurately track that and then work with the tenants to move those buildings towards net zero carbon. So, being able to do that, being able to get access to that data and then engage with them, that is a real challenge across the industry. And then finally, the reduction of embodied carbon in real estate developments I would highlight as the third key challenge. So we have a relatively good sense of what it looks like to reduce the energy consumption in operation of a building and get it towards something approaching net zero carbon in operation. But there is much less available information out there around what it looks like to decarbonize a development, how you replace materials such as concrete and steel, which have a very high carbon value, with lower carbon alternatives, either of lower carbon steel and concrete or different materials altogether, such as timber, reducing waste. And there's a lot of high level information around broadly what you need to do, but the specifics of what is what is an acceptable level of embodied carbon in a building, what are the steps that you go through to get there, and also the knowledge of those working in that industry of how to do that, and the acceptance of that is lacking. So the tenant engagement, embodied carbon, and lack of certification are the three key challenges that I would point to at the moment.
Thanks, Abigail, for those three topics, and we'll be getting back to the lack of shared frameworks and definitions with Nicholas in just a moment. I'd like to hear Stefan's point of view from Evaluate Cambridge with regards to carbon. Stefan, if you can share a few thoughts here on the topic.
Yes, sure. Good morning, everyone, and thanks for the invitation. Maybe let me just briefly introduce who Ivanhoe is for those of us who don't know us. We are the real estate arm of CDPQ, the Quebec pension asset manager, so based in Canada. And we manage a global real estate portfolio of about $60 billion across regions and sectors, from office to living and logistics. So a bit on carbon, a bit similar to what Abigail just mentioned for Nouvean, we have also set a 2040 net zero carbon ambition for the global portfolio with 2025 interim targets. And we expect our asset managers, our investment managers, to work with us to help us get there. That's definitely something we need to deliver on in collaboration with our ecosystem. So for now, our targets relate to what we call operational carbon, because that's where we can have actually the highest impact today. And I was glad to see that, you know, the study findings confirmed that this is indeed where the industry's focus should be. And Dominique and you, Ella, and also now Abigail, you know, have confirmed that this is indeed where we have the best, you know, methodologies, data quality, and levers to improve. We have these statistics that 70% of the 2050 building stock is actually already built. And also for Ivanhoe's assets, the vast majority of our properties are already stabilized and have been built many years ago. So we've made that choice to really focus first on improving standing properties. We have about 800 of those, and then focus on their operations and how to reduce mainly energy-related emissions. When it comes to embodied carbon, Abigail, you just mentioned, you know, challenges associated with that. You know, fully agree with you. It's still a high priority topic for us, and I think the industry is really actively collaborating on to overcome those data or technology or methodology challenges, and that's I think a collective R&D effort that's ahead of us. And so as real estate investors, I think we need to put our money in a common sort of pot to work together instead of having our own R&D initiatives on the side. That's what led Ivanhoe to invest in prop tech funds. For example, the Fifth Wealth Climate Tech Fund. So investing alongside other real estate LPs to grow those climate tech solutions, which will help us. In terms of embodied carbon, we've also made some progress despite challenges with making investments in low carbon development ventures here in the US, but also in France through the IKEA Wood Fund as an example. So goal being to develop low carbon mass timber framed office properties in the Paris area for that particular example. So clearly a big focus on standing asset, operational carbon, but embodied carbon clearly the priority. And we committed to add to our carbon targets this embodied piece within the next 2 years. So we know we have a lot of work ahead of us, but we hope to work with you all to solve that.
Okay, great, Stefan. So operational carbon, embodied carbon, and an investment dynamic in PropTech to move the topic forward. Okay, so what I suggest is moving from the carbon topic and going into a topic that's already been pinpointed, which is the lack of shared frameworks and definitions. I'd like to move on to Nicholas and hear your thoughts, Nicholas, on this topic. Justina is a listed real estate company, and you have in-depth experience in CSR reporting. What are your views with regards to this challenge?
Oh, well, thanks Ella. As Dominique and Christian said it in the beginning, data quality is an issue, and comparability as well, because regarding, for instance, energy consumption or GHG emissions for standing portfolios, some owners report only on the common parts, not on the private parts on the buildings. For instance, in France, we have a specific calculation for energy consumption because we multiply electricity consumption by 2.58, what we call primary energy, which is the metrics used for the DPE in DPE label, for instance. So as I say internally, it's like 50 shades of energy consumption only, and when it comes to GHG emissions, it's both the same, because sometimes we track it and divide it by square meters, sometimes by the number of occupants of the buildings. Sometimes you correct it to take into account whether it's been a hot year or cold years, you know. So there are many different ways to calculate it, and we have feedbacks from equity investors and debt investors as well, that data is not comparable. And if it's not comparable, then they can't make a fair assessment. If they can't make a fair assessment, then they can't take it into the decision process. But I would also like to highlight the fact that energy consumption and CO2 emissions At least right now, we managed to measure it pretty precisely and clearly. Mentioning the embodied carbon, I think it's still a long way to go. For instance, in France, when you measure embodied carbon, a government-based database highlights 2,000 life cycle analysis, so products that measure the embodied carbon, and then you pile everything, and finally you measure the embodied carbon of the real estate project. So 2,000 building materials. Approximately, there are 600,000 building materials in the market in France available. So, and when you make a life cycle assessment, the error margin ranges usually between 50% and 100%, because it's challenging to measure. It doesn't mean that you can't use it. It will still guide you, as Abigail said it, for instance, to lower carbon materials, and you have to use it that way. It's just that when it comes to setting up targets, metrics, and incentivizing, for instance, your staff or your development managers, then they might be not very comfortable with it. So, for instance, with Jessina, we implemented a target a few years ago, which is 735 kilos of CO2 per square meter developed. In France, the average is about 1,100, for instance. We're measuring fine, and we are progressing fine toward that target, and our buildings that we are developing right now are matching these targets. But we're still skating on thin ice. Data is weak, but let's see the glass half empty and just say that we're using it towards lower carbon decisions, and that's the point of data. And from that point of view, I believe that the taxonomy will definitely help. The IPRA database and the IPRA standard is also very useful because it's providing a calculation method for indicators. So if you use it, you have to comply with this calculation method. I think it was a mistake from former reporting guidelines, not just listing a few KPIs and listing indicators. You don't ensure comparability, and you open the door to oh, I'll pick only that part of my portfolio. I'll forget to count that side of the carbon footprint. So I think all those frameworks nowadays are understood that they need to precise everything to ensure data comparability. Of course, it brings a bit of complexity, but again, from our experience at Jessina, if you take time, for asset managers are very metrics-driven people. It won't take more than a few hours with them and working on a few projects, digging into data, and they will get it. Definitely, the only thing they need to know is how do you calculate, how do you come up with GHG or energy emission. It takes half an hour, and then what's the benchmark? What's the benchmark, and what can I do to improve? So you can make it much easier than everyone believes. I think you don't need to be reporting sustainability specialist to drive decision making into lower carbon, for instance.
Right, and you mentioned the taxonomy, Nicholas. I'd like us to look into that a little bit more with Christopher, and the interesting point that you raised about these many different ways to calculate emissions, look at energy use, and the comparability of data. There's a question that kind of derives from that, which is, are we approaching a standard definition of what a green building is, in a certain sense, if I had to sum that up, or are we still far away from that? Christopher, what's your view on that?
Yeah, no, it's a great question, and it's something that Abigail also mentioned with her comments on net zero, right? I think what we're seeing now is one of the challenges, to get back to that, is that there are conflicting kind of market signals here. So fund managers that are looking to kind of meet expectations of green buildings don't know where to look, how to measure, what to benchmark against. And so one reason for that is that we have a multiplicity of certification schemes, which is also mentioned in your survey as a major challenge, that at least for fund managers. So those certification schemes, LEED in the US, BREEAM in the UK and most of Europe, HQE in France, DGNB in Germany, DBJ in Japan, etc. Green Star. So these are kind of originated in national markets to kind of cater to the needs of architects, developers, property owners in those markets, and they were also driven by the regulatory realities in those markets. And of course, what's happened in the last 10 years is that institutional investors with global portfolios are reusing those schemes to understand kind of the green characteristics of properties and their portfolio as a measure of risk. And so then it becomes a problem if these schemes are not comparable and don't use the same metrics. There are efforts kind of to try to harmonize some of this, but we have to recognize that those are organizations that have a wide variety of stakeholders, and most of those are in national markets. They're not kind of global players that want this comparability. So you have to look elsewhere, or at least they can't do it themselves. What would help is some kind of regulatory harmonization. So say if the EU taxonomy comes up with a good system, and there are efforts underway within the EU to kind of export that to other markets. So you could foresee some kind of a basic metric over time being used by different regulatory agencies in different markets, and thereby kind of create more harmonization. So I think that's probably the best solution here and most promising. But all of us, and including the organizations that are represented, EPRA, for example, in INREV, we have I chair INREV's ESG committee, and so we're working to encourage that harmonization. So the industry organizations in different regions have to work together to make that happen. But that is a major impediment to kind of to both also on the valuation side. Going to that question, you need comparability to integrate this into valuation ultimately. But we're getting there, and it will never be perfect. And the key is that we have to do something before. We can't wait for it to be perfect. We have to make decisions under uncertainty and inadequate data. That is just a reality that I think we have to accept.
And we get back to what Abigail was saying about a stamp that actually provides a credible certification for net zero carbon buildings. And what I'm hearing, Christopher, is that it's a collective effort, just like what Stefan was mentioning, working together at a European, but also more broadly at a global level. Okay, so we're going to move now to our third topic, which is the S of ESG with regards to social issues. And we've talked about, and the study has really highlighted environmental performance of assets as being key issues. But we also see that there's an increasing trend to take into account the S of ESG, such as the affordability. Stefan, how do you approach affordability at Ivanhoe, Cambridge?
Sure. Yeah, I was actually glad to see that interviewees in the survey brought up this topic, because it was not part of the initial list of the sort of social issues that they were asked about. And indeed, housing affordability, or rather actually the lack of housing affordability in big cities globally, is a significant challenge, and it has far-reaching social consequences, social mixity, urban sprawl, gentrification. And so as institutional investors, we do have a responsibility to tackle that challenge, because public authorities won't be able to address the topic by themselves. They need private capital. And we know that private capital also often finds it difficult to make the math work from a return standpoint. Land values are so high, as well as construction costs. So again, there is a need for partnership between public and private spheres or players to make these investments work also from a return perspective. But definitely on the S side, yeah, affordability is a big, actually maybe the #1 priority. Maybe an example of that is a partnership we just announced, a 150 million fund in Quebec, dedicated to affordable and family housing. We need to ensure that everyone has a roof. You know, when we talk about corporate social responsibility or responsible investment, we need to ensure that no one is left behind. I mean, needless to say, that's sort of a basic need for society. And it's not only about providing social housing, it's also about housing that is affordable, that remains affordable to, you know, middle class workers. That's also senior housing or even healthcare. And these alternative sectors are supported by strong demographic trends, and they also bring diversification and resilience to residential and to real estate portfolios as a whole. So I think we do need to put more effort on that, on those alternative sectors. Obviously, a key impact a key challenge that we also face with the S and including on affordability is impact measurement. We lack common standards to measure social value. That was also discussed by Nicola and others on the E, but on the S, it's also really a big challenge. I'd like to mention ULI Europe just did an excellent review of available tools to measure social value. And I think that's maybe a promising way of doing so, which we are testing at Ivanhoe, is about assessing social return on investment. So, for example, as you compute, an expected financial return, you would say investment X in affordable housing is expected to have a 10% per annum 10-year return socially. That would capture the socioeconomic benefits generated from affordable housing through higher disposable income, for example, or better education or better health outcomes. So when we look back maybe 10 to 15 years, we did a lot of progress on the E side and how to track and collect energy carbon data. And so I'm quite optimistic that on the S side, we are seeing increased levels of commitment and also innovation in how we address and measure those social impacts. So I'm quite hopeful for the future that this is something that will be take a larger place in the ESG. The S will take a larger place in the years to come.
And especially what we saw in the studies, the metric side, how do you monitor social value? So it's great to see that there are studies coming out looking at that topic as well. With regards to another topic which seems key, which is the link between financial performance and extra financial performance. If I can keep you, Stefan, on the mic here, with regards to that topic, can you tell us a little bit more on how that takes place within your organization?
Yeah, sure. Happy to share a few ideas, and I'm sure others will also contribute. Maybe first, I think the extra financial or non-financial as a word suggests that ESG aspects are not financially relevant or not material, which I think we all believe is not true. Over the long term, those ESG aspects do have a financial impact, and as a fiduciary, we think long term, and we also look for both optimal risk-adjusted returns as well as measurable social outcomes. So we aim for that sort of double impact. And we clearly believe, and it's demonstrated by multiple research, there is a positive correlation between financial and ESG performance over the long term. It's quite well documented, especially in the real estate sector. Obviously, every dollar of energy saving comes from energy efficiency efforts. A recent example of that on the S side, again, coming from the MIT, showed that, for example, a 5 to 7% rent premium in the US for so-called healthy buildings, buildings that would feature advanced health and wellness amenities for occupiers. And this premium, what I think is interesting in this study, that they have been able to demonstrate that the premium is independent of all other quality factors, such as green certifications, building age, sub-market dynamics or renovation dates. So that is, I think, one of these signals that do demonstrate the close and positive correlation between ESG and financial performance. And we believe that the current environment, with this COVID pandemic situation, this is accelerating the link between ESG and financial performance. It has been mentioned by all of us here, this increased interest from tenants, from investors, from regulators on the topic of ESG. So this sort of convergence of their expectations from multiple stakeholders, that leads to further divergence on the market, in our view, between assets that have these ESG qualities and those that do not. So when a new tenant comes in town, for example, I think it's quite obvious that the office properties that do not have those ESG qualities may remain, below in the pile of available assets for rent. And while it may not lead to a green premium in certain markets, we will certainly see a discount, for assets that lack that sort of ESG quality. Maybe one last or concrete example also, I think quite interesting in terms of the connection between ESG and financial and returns is, and it has not been mentioned, I think, in the report, that relates to sustainable financing, green bonds or sustainability linked loans. I think the real estate industry is quite active these days in issuing debt where the cost of the debt is linked to the ESG performance of the issuer. So, for example, in our case, the lower our carbon footprint, the lower the cost of debt. I think that's a fairly simple and concrete way, again, of aligning financial and ESG performances.
Okay, great. Thanks, Stefan. Nicholas, can you tell us a little bit on how you attempt to respond to this challenge of imbricating financial performance and extra financial performance at Gecina? And then I'd like to hear Abigail and Christopher also on that topic, because I think that's also a key point here to look at.
Sure. I think since I've been working into the field of sustainability, the challenge is how to embed into day-to-day practices, especially from investment managers or asset managers. So broadly you have to approach. Either you have on one side the ESG score and the financial score, and then you set up rules such as, oh, you can't invest in a stock or in a building that doesn't match at least 50 out of 100 or something. Or you have let's say, the embedding and melting approach, which is the one we are testing right now at Gecina. We used a few studies such the one as Stefan mentioned, but also from the MSCI, that uncovered a positive link between sustainability performance of a building and the rent you can expect, liquidity you can expect on the market when you sell it out. So we use that studies and ranging out an impact on the internal rate of return. It's our belief. It's evidence-based from a few studies, but it's still something that anyone can criticize, of course. But that's how you make a shift, I think. And our ambition is to have this KPI for decision, and that KPI is still internal rate of return. It's just that you factor ESG performance into it. Just as on the equity side, 10 years ago, some leaders have said, okay, it's been 10 years, I've been scoring ESG performance of equity and stocks. My fund managers don't have a clue what it means to be 60 out of 100 or 40 or 80. So I need to use and to put on their lenses and to use the KPIs they know and they master. So I'm factoring, for instance, ESG performance on the target price. That's what, for instance, Odo Securities did, I think it was 10 years ago, or Robeco Asset Management when they integrated the Sustainable Asset Management Fund. So I think it's the future of ESG, and either you try to make a revolution or you try to adapt current decision-making tools and embed ESG into it. And that's what we are doing at Gecina, and we found it very insightful, and and quite empowering for our investment teams, because we have a grid partly based, for instance, on tools that was developed by the Better Building Partnership, the due diligence on ESG that was, for instance, translated in France by the French Observatory for Sustainable Real Estate. That's that very insightful, useful tools that could be developed on the market and quite easily on the European side. And from that score, we determine an impact on the internal rate of return. I think this is the only way to really integrate and embed the ESG. It shouldn't be left apart. It shouldn't be one in financial information and ESG information apart, because otherwise it will still be forgotten, or it will not be a priority, I believe.
Abigail, what do you think of what's just been said about financial performance and extra financial performance? How do we reconciliate both?
I completely agree with the approach that Nicolas just set out, and it really mirrors how we look at it as well. That we don't see the two as separate. So the ESG performance of buildings will have an impact on the financial performance. I think that the challenge is understanding over what time frame that's going to take place and how that's going to impact different real estate sectors and different markets in different ways. So, if we come back to the conversation we were having at the beginning around the transition to net zero carbon buildings, the implicit in that discussion is the fact that buildings that are not net zero carbon will lose their value or become obsolescent. And I think that's the whole reason why we've set our goal. So the challenge there is taking that assumption, which is over quite a long time horizon, and thinking, what does that mean in the next 5 or 10 years for this particular real estate investment? I think it's really interesting that a number of the big real estate valuation houses have I feel like are actually really grappling with this issue in a much more meaningful way now. So there's an interesting paper released, I think, last week from JLL, setting out how they are going to start more explicitly taking account of this in their valuation of offices in particular. I think that some of the others have taken on specific sustainability teams into their valuation teams recently. So I think we can expect to see a more explicit acknowledgement of the sustainability performance, particularly that transition to net zero carbon being taken into account in real estate valuation. And when that's being done, that kind of it automatically obviously will flow into the more naturally into the underwriting and return on investment calculations that are done. So it really is all part of the for us it's very much embedded in. That it is difficult sometimes to, I think what's challenging is to be able to isolate the sustainability performance of a building compared to all of the other elements. If you're doing an upgrade of a building and making it more sustainable, how can you separate the sustainability performance from the fact that you've put in better amenities and it looks nicer and you've upgraded it? So I think that's always been a challenge, but I think common sense tells us that the more sustainable buildings are, the better they're going to hold their value. So the two aren't necessarily separate. I do think it's a bit more challenging on the social side to make that more direct link, but I hope that comes, because I think as well common sense tells you that buildings that better meet the needs of local communities that are providing a useful service to a community and are meeting buildings that are socially useful will also have a longevity to them and will maintain their value over the longer term. But it is more challenging, I think, to explicitly link social value with financial performance. I'm not saying that it can't be done, but I think it's we're less far along that journey than we are on the carbon side.
Christopher, on this topic, any thoughts from Norges Bank?
Yeah, sure. So to take a specific example, I mean, I agree with Abigail and Nicolas' comments. This will become increasingly important. I think we see that in And we expect to see that in a kind of transaction analysis, right, in the acquisition phase, when you're particularly buy and hold investors that are going to buy something for the long term. Suddenly, you know, it matters with these targets that are fairly draconian and strict, you know, for 2030 and 2040, you have to start thinking about the relative position of that asset in 20 years time, and whether there are any inherent limits to reducing emissions or energy use from the building, given its, you know, its structure, the building envelope, the major systems in the building. So that means that you know, the historical energy performance of a building becomes a much more material data point. If it is very, very poor compared to comparable buildings, and that should over time result in some kind of discount and reflected in the underwriting, because you might have to then allocate additional capex in your hold period to rectify that. So that's you know, so in that sense it will seep into the valuation. The other thing I wanted to mention was the physical climate risk, which we haven't really addressed, but particularly flood risk, right? So this is a similar case where the historical flood record in any given city is not a very good predictor of future flooding in most locations, particularly those along rivers or on the coast. There will be sea level rise, there'll be more extreme weather, there'll be more precipitation. And so again, you're interested in knowing there'll be much more scrutiny around flooding events that have occurred at the location, but also the resilience of the building to future flooding and the predicted flooding in that location or in that market in the future. So I think the time horizons you know, are going to get longer, and I do think assets that might have some inherent limitations to address to becoming more resilient will be traded at a discount.
Yes, well, you mentioned one of the key topics that we'd like to address in our last section of this panel with regards to prospective trends, which is climate risk, climate adaptation, resilience. Can you tell us a little bit, Christopher, on you know, how that's taken into account currently at Norges Bank, and maybe what's your action plan to tackle that issue?
Yeah, so I mentioned initially that we have a portfolio that is highly focused on office, retail, and logistics. The office and retail portfolio is concentrated in eight global cities, 4 cities in the US that are on the east and west coast, London, Berlin, Paris. So 3 cities with, you know, along major rivers, and Tokyo, a coastal city. So flooding risk is really important for us. And so what we have done to understand that risk is the starting point is basically identify the share of assets and the share of portfolio value that's located within 100-year flood zones in those cities. And that gives you a sense of the current flood risk, assuming that the flood risk doesn't increase in the future. Supplementing that, we have purchased some climate scenario data that has basically looked at the future flooding rate or expected flooding in those locations, given 3 different climate scenarios. So kind of a low scenario in which you know, if we succeed in kind of limiting temperature rises to 2 degrees, that's kind of a best case. The business as usual case is maybe 3 degrees, and then there's a kind of a worst case that is commonly used, RCP 8.5, which is you know, generates the most climate risk. And then we can see kind of how our different assets will fare, and then we'll have and at what point in the next 50 years you know, flooding will become much more intense and more frequent. And then we can speculate as to when that will begin to be priced into the market. So it is basically an attempt to understand that risk better using various kind of analytical tools.
Great, Christopher. Nicholas, I think climate risk is also a topic that you address at Gecina, at least having it on your radar as one of the prospective key trends.
Sure. I mean, it's in a taxonomy anyway, so I guess everyone will have to comply. And just for those who don't know that yet, you can have a net zero building in use. If it's on a floodable area, you can't qualify it as green. So check out for European investors where the locations there are, and use the different tools. I think it's I would like to highlight the fact that there are many available tools right now. It's a concern for sure for investors, but at least it's a concern that you can address now, because there are some third parties that are very specialized on this, such as 427 or MSCI, for instance. You have also freely available tools, such as the one from the French Observatory for Real Estate, that you can easily determine the risk. So there are many different tools right now, and that's the kind of tool we are using to qualify and to identify what does such risks mean. What are different risk categories, and more specifically, what are the counter measures to address and to tackle that risk. So that's what's the most interesting side of the assessment, is how can I tackle this, and it's actually on a more prospective side, what we are doing at Gecina for all our other CSR priorities, such as biodiversity, and as it's highlighted on your study, it could be seen as a complex issue to capture, but it's not so complex if you take the time to ease off the reporting side and the methodologies that are available on the market. And it's possible, and for as a return of experience, we have an asset manager who didn't know a clue about biodiversity 3 months ago. He decided to renovate the vegetated area of his building, and when we presented the project to our executive committee, he looked like he got a PhD on ecology and biodiversity, and I'm not kidding. That was astonishing. So we also have the chance to work on issues that are very interesting for our colleagues, and that means we should take time to empower them on this. Because there are many various and diverse issues looming regarding CSR, and we need to tackle every bit of it. That's why also now concluded on that question, that I would suggest a new motto for real estate. We all know the location. And as Dominique said, we shouldn't forget about renovation. It's still the best way to lower embodied carbon, to develop on brownfield instead of greenfield areas, to save our biodiversity, and to ensure that we are developing and operating on safe fields and safe areas versus climate change.
Thanks for that, Nicholas, and thank you for sharing that example of your asset manager who really wanted to tackle biodiversity. And as we saw in the study, biodiversity is one of the topics that is also on the radar, difficult to tackle. Is that a prospective trend that you as real estate professionals see? Do you see movement towards more integration of biodiversity? Just wanting to jump back on that particular example, Nicholas, that you mentioned.
It's actually driven by clients. I believe we are a generation that needs to be reconnected to nature, and everyone, especially in a city as Paris, where we're mostly invested in, that is not very vegetated, unfortunately. In opposition to London, for instance, we have huge parks in the middle of the city. We don't have such things in Paris, especially in the CBD area. So our clients really enjoy having a few square meters of vegetated space, and it's also interesting when your business is about fragrance, is about distribution of food, to highlight on your headquarters and have a glimpse of your core business model regarding sustainability. So it's all interesting from a very business side perspective to integrate biodiversity, and it's also a good thing of course for carbon and energy performance, especially in case you bridging up with a resilience and adaptation to climate change. In case of a heat wave, you can lower the impact of a heat wave, especially by night, because a vegetated area cools off much faster than a concrete facade, for instance. So it's a very positive impact brought by biodiversity. Let it be on well-being, let it be on carbon emissions, let it be on just the beauty of a city. So yeah, we're very in favor, and we really acknowledge that our colleagues might see it as a complex issue at first, but when we take the time with us to train them and empower them, they definitely see why it matters and how they can help as well within their day-to-day, and how they will be able to seek higher rents with the clients interested in biodiversity.
Maybe if I may just add a quick
Stefan.
comment on biodiversity. I think it's quite interesting to note that this topic is brought up mainly in Europe, at least in our experience. It's not so much a topic that we're asked about outside Europe, like in North America or in Asia. So I think Europe is at the forefront on biodiversity and has something to teach to others. So quite interested to see those developments, but a bit also surprised by the fact that is not yet picked up by other regions yet.
Christopher, do you agree with Stefan as a global player? You were talking about 8 global cities earlier on with regards to biodiversity.
Yeah, I think yeah, it's probably true, and that is kind of the reflective of a broader kind of ESG agenda. There's a lot of things that happen in Europe first, but I do think that especially these big cities that we are invested in, there's a increasing attention being paid to green spaces in cities. I mean, this is something the populations want, they value. People want to live and work near green spaces, and that impacts the occupier market in terms of where they locate their assets. And then that also translates into, like Nicola said, into a demand for greenery at the buildings. So for example, in our US cities, we've seen a huge trend in building out roof spaces with greenery, right, with vegetation, for the kind of obvious urban heat island effect, and kind of the benefits to the building itself in terms of energy efficiency, but also as an amenity, as a place that people want to meet at and have events at, and so on. So I think it's a particularly strong trend in big cities where this is something that people want to experience, and it has aesthetic value, but it also has value in terms of productivity, the studies on biophilia and its impact on concentration and so stress and so on. So I think this is becoming, it will become more and more important as going forward.
Great, thanks for that. I'd like to hear Abigail with regards to prospective trends. If you've got any thoughts on biodiversity and maybe other trends, Abigail, as you're looking towards 2040 with regards to net zero carbon.
Yeah, and I think I definitely echo the thoughts of the rest of the panel on biodiversity. I think it has been a somewhat neglected area, and it's often sort of referred to as the sort of the other half of the coin. When we look at the impact of climate change, there's a real focus on reducing carbon, which is absolutely critical, but equally as important is to focus on biodiversity loss. And what is needed is for that to be integrated more into regulations and planning requirements, and for there to be a really coordinated effort between the public and the private sectors to focus on protecting biodiversity and enhancing biodiversity. So I think that we absolutely will see more of a focus on that in the future, but it's definitely much less think, understood by the real estate sector what the key actions are to take on that, whereas the reducing carbon is maybe better understood. I think as well that, you know, the reality is constructing a building and operating a building is very carbon intensive, and that is a detriment that the real estate sector has. So reducing that detrimental impact needs to come, you know, it needs to be front and center of minds for real estate investors. Whereas the biodiversity is maybe not as immediately obvious, you know, what the role of the real estate investor is there. But you know, I think the pandemic has really accelerated this kind of connection that people have with green space, and means that people are valuing greenery much more than maybe they did in the past. And the other, you know, key trend, coming back to the climate risk discussion, so in terms of physical climate risk, I think that is being better understood. Although I think at the moment there is a tendency to kind of look explicitly at what is the potential cost of climate events on real estate and turn that into a value at risk. I'm not sure that's necessarily the most effective way at looking at it, because you can very quickly there just look at, well, we're insured, so we don't need to worry about that. Whereas there's a much broader consideration to have here around, well, what is the impact of climate events going to be on rental growth? What is the impact going to be on liquidity? What is the impact going to be on insurance premiums in the future? How effectively is the insurance industry going to be able to continue to provide insurance for real estate in high-risk areas? What is the role of government there? How effectively are governments investing in defences, and to what extent can that be taken into account? So it's you know, the kind of understanding of what impact physical climate change is going to have on the valuation of a building into the future, particularly if you're a long-term investor looking at holding buildings for 10 or 20 years. I think that's that kind of the level of the depth of knowledge and understanding around that will really grow. And I think that's the kind of the biggest trend that I see actually is picking up on all of the points we've discussed, is this mainstreaming of knowledge of these issues. It was really wonderful to hear Nicholas talk about the passion that some of his colleagues have for these issues. That's what we need to see across the whole industry is, you know, we need to lose this kind of the sustainability people and the asset management people. They all need to be the same people, because you know, these, you know, biodiversity, net zero carbon, the embodied carbon, impacts of climate change, these are all going to have very meaningful impacts on real estate value into the future. So everybody working in the real estate industry needs to make that a key part of their day-to-day role, and there needs to be a real step up in the training around that, and how that's incorporated into degrees on real estate management, and the ongoing professional development of all of us working in all different parts of the real estate industry. This needs to be a much better understood issue. We're definitely, I think about where we've got to in the last decade, it's, I think that we've got streets ahead on that, but probably a little bit further to go still as well.
Okay, so growing trend for biodiversity. We started out with lowering carbon emissions and talked about climate risk, which is the other side of the coin. There's mitigation and adaptation, and this key issue of training that I've just heard from you, Abigail. So education of real estate professionals and making that all these different topics mainstream. So it's 11:46. We've just had 1 hour of panel. We've kept our timing. And we've got a lot of observations and questions from our audience. So I'll pass on the mic to Christian for those questions.
Yeah, thank you very much. It was really a very interesting roundtable, and there are a lot of questions, but you answered progressively to nearly all of them. But I've got some more questions for you. Do you think that we talked a lot about the lack of data and the lack of comparability? One question is, do you think common accounting standards through IFRS board, for example, but perhaps also some other thing, could bring consistency. And there is the same question on valuation standard, but you already mentioned the point. Who wants to answer?
I can provide a very short comment, which is that's kind of the end game, right? I mean, the summary of this panel is that this information and this data is becoming more material and has financial relevance, and so the end game then is that it has to be treated equally and integrated firmly into financial accounting standards and valuation standards. And then there's obviously efforts on both fronts, and there's some technical challenges to doing that. But I believe that if in the future this will have to happen.
Mm-hmm. Thank you very much, Christopher.
Maybe one quick additional comment.
Stefan?
For example, you have the SASB, the Sustainability Accounting Standards Board, which is providing some financially relevant indicators for the real estate industry, and climate, which we've all discussed, is well reflected in those standards. I think it still remains a bit limited, and today, I think the main tool we have to get some data coverage fairly consistent across the globe remains GRESB. And so it's good that this was also highlighted in the study as the #1 or most adopted framework. Despite the wide diversity, the multitude of green building standards and labels, I think GRESB at the portfolio level remains and will remain, in our view, the gold standard. So it's not a perfect benchmark tool, but still, I think it's the best available one.
Does the two of you agree with what Stefan said?
Yeah, sure. I mean, on Gessine's side, I think we take on the GRESB questionnaire since a decade or something. We've seen it evolve. Well, the only thing is always a bit concerned regarding governance changes regarding GRESB and what's coming up next in the future, and data comparability as well, because they're told that they are focused much more on the quantitative data, which still has to be put into context from my point of view. The only thing is, well, we got a score, but unless you are a member of investors, and maybe some of you guys are, you can't really access benchmark data unless other benchmarks. I know in UK, the Better Building Partnerships publishes data from UK REITs, for instance, for free, and I believe all the actors there find it insightful. We have the same in France with the OID, maybe in other countries as well. We have government data. And I think I'd rather compare myself on raw data than on scores provided, even if GRESB is a very, very serious benchmark, and the checkup, for instance, data, which is not the case from other ratings that are mentioned in the study, such as CDP, So I think it's very reliable, or to put it in other words, as reliable as an external benchmark can be.
That's right. Any news on a European equivalent to the French BBCA certification, which is a non-carbon
label initiative?
Yes, thank you very much. So you mentioned, Abigail, you mentioned something about net zero carbon goals or label or certification. Are there some work on that at a European level, on your view?
I think there is. I think that BREEAM, for example, is actively looking at incorporating the CREM pathways into its certification, which would be a real step forward. So I think that there is work going on to address that. I would really like to see as well a more concerted effort to bring together the whole life carbon of a building. And I think that this came up quite a few times in our panel. the challenge I see with the focus on the operational efficiency that you need to get to, and particularly the very stark reductions that you see being necessary in the CRREM pathways by 2050 is it's more newer buildings that are able to meet those goals. And really, we don't want to kind of have a perverse incentive for lots of new buildings to be developed. We really need existing buildings to get much better. And I think we've all kind of many times said, it's better to refurbish and redevelop what's there. So I think that something which can bring together that operational and that embodied piece and give you a kind of whole life carbon certificate would certainly be the best. That would be the gold standard. I think that various different certification bodies are looking at it. I'm not sure there's something that's perfect out there. I also think, for good reason, it's very difficult to gather all of that information together, verify it. This comes back to some of the points that were just being made around reporting standards. The level of verification and accuracy in that data, it's not equivalent to what we see in financial reporting, and that is where we need to get to. So somewhat frustratingly, we're still on a journey with that.
Nicola?
Sorry, I couldn't unmute myself. As a member of the lower carbon building association, I couldn't take up regarding European levels. Well, I was a bit frustrated, as probably most of you guys, regarding the taxonomy that only forces for buildings higher than 5,000 square meters to have an LCA. Well, it's Europe. Sometimes it's complicated, to force other countries that are still lagging behind on such matters to have performance metrics on this side. I would like to remind everyone that there's also the level project at the European level that is working on this. I don't know if it will come to another label. Maybe we could save another label, honestly, regarding real estate. But at least if it could help up, and I think it was a question from Juliette on the chat. In France, so we have this regulation forcing every building, a newly built building, to have an LCA. That means that if you're building materials supplier, you're off market if you don't have the LCA of your material, because no one will use it in the buildings because they wouldn't comply on regulation. So that would very much, hopefully, spur the data availability and will help us all track and monitor more closely embodied carbon and eventually, curb it. I think it's feasible. I think on the next few years, data accuracy will enable us big savings, but let it be virtual savings, because it would probably just be related to data quality and hard choices regarding the shape of a facade, for instance, of a traditional office building. That would be more hard talks, I think, within players in the industry.
I've got a last question. Of course, there are a lot of others, but time is running. And perhaps for you, Christopher, and of course for all of you, how much do you think should a carbon tax be in order to effectively incentivize a key markets player? Which is a tough question.
The European Commission is watching.
Yes.
Yeah. Well, it is not my role to set the carbon price. What I can say is that we expect it to increase. I mean, this is most obvious in Europe with the market projections, and this will also then affect. It will give you higher cost savings if you reduce your energy use, for example. It would also make it more attractive to move to renewable energy sources, whether it's on-site renewables or credits or some other way. So So I think the tax or the penalties for carbon intensive operations are going to increase, but that's only one of the levers. I mean, there are other, as we've talked about, tenant demand technology, other things that will impact this. That will be one of them.
Does any one of you want to add something?
I suppose the only point I would make is I think it has to be quite a bit higher, because at the moment it probably isn't high enough to actually affect real change. There are a number of UK REITs recently that have set an internal price of carbon as part of their net zero carbon transition, like British Land, I think Great Portland Estates and Derwent London possibly. Apologies if I'm misrepresenting what any of them done, but some really interesting work there. And I think they ranged from sort of 60 to 80 or even 90 pounds. So, up to 100 euros or so. So I'm, as we have not done that, but I very interestedly read the papers that they all produced, looking at how they were going to incorporate that internal price of carbon. And it was interesting to see that range as maybe being one that does start to have a meaningful impact on decision making. So I would point to those who've done some interesting work, and certainly for those it would be that would be worthwhile looking at those. They're all publicly available.
Thank you, Abigail. Nicola, you wanted to add something?
A very quick comment on that, because we set up an internal carbon pricing as well 2 years ago. It has to be a transformational approach. As I mentioned before, for instance, we are taxing our development projects when they don't meet the 735 kilos of carbon per square meter, so that they're really incentivized to meet the targets. Same for emissions in use, in line with our target to achieve net zero by 2030. So I think it's not only a matter of cost of a ton of carbon, it's how you apply it to make it transformational, and how you use the funds that you collect with these taxes. How do you spur internal innovation? Because we're an industry that is sometimes risk adverse. And regarding carbon and energy management, you have to take risk. You have to initiate new actions. And I think, at least from our perspective at Gecina, we supported 15 projects, innovative low carbon projects, thanks to the money we collected with this tax. And I think it was, just as the same comment as biodiversity, it's great to see colleagues that have never intervened somehow on CSR getting into the game, and really tracking and explaining. We have asset managers that took a look for the first time on LCA, and asset managers for in-use. It's more common in development. So again, it's a great initiative. It just has to be used very rigorously and embedded into again the processes.
So thank you very much. I really want to, in the name of Ella and myself, I really want to thank you, all of you. So Abigail, Christopher, Stefan, and Nicola, thank you. The roundtable was very, very interesting, but of course the study will be is very interesting too. So you can download it. You will be able to download it for free on the Green Soluce website, and you've got the address on the screen, and on the IEIF website as well, from now to October 6th, because we wanted to have this period for letting you having access to the study. Thank you very much, and we look forward for the next edition of this study next year, and we will follow how industry is moving on ESG. Thank you very much.
Just a very quick word, Christian. Just to mention our partners once again, that we were delighted to have EPRA, INREV, Eiendom Denmark, IPF, IVBN, Norsk Eiendom, Reckley, Women in Real Estate Spain, and ZIA. I'd like to mention ZIA for the German market as well. So 9 organizations with whom we wouldn't have been, without them, it would have been very difficult to carry out this first edition of the study, and we'll be looking forward to hearing from everyone very soon, and again next year for the next edition based on everything that we've just said. Thanks very much, everyone.
Thank you very much, everyone.
Thanks.